Namaskar. At the outset, I would like to extend my season's greetings to everyone. This is the monetary policy statement for the month of October, and this is how it goes. Kautilya, in his Arthashastra more than 2000 decades ago, had said, "Stability enables a state not only to share its wealth equitably, but also augment it." These words are relevant even today. In fact, they have eternal validity. Macroeconomic stability and inclusive growth are the fundamental principles underlying a country's progress. The policy mix that we have pursued during the recent years of multiple and unparalleled shocks has fostered macroeconomic and financial stability. The external sector also remains eminently manageable. The twin balance sheet stress that was encountered a decade ago has now been replaced by a twin balance sheet advantage with healthier balance sheets of both banks and corporates. India is poised to become the new growth engine of the world. The need of the hour is to remain vigilant and not give room to complacency. Lessons from the past 1.5 decades and from living through the global financial crisis and the taper tantrum tell us that risks and vulnerabilities can grow even at good times. All stakeholders in the economy, be it lenders, corporates, businesses, both small and big, and even policymakers should continue to reinforce their buffers and fundamentals in the fast-changing world that we live in. So far as the Reserve Bank is concerned, we have identified high inflation as a major risk to macroeconomic stability and sustainable growth. Accordingly, our monetary policy remains resolutely focused on aligning inflation to the 4% target on a durable basis. Excuse me. Let me now turn to the decisions and deliberations of the Monetary Policy Committee, that is the MPC. The MPC met on 4th, 5th and 6th October 2023. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, it decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, and the bank rate remain at consequently the standing deposit facility rate remains at 6.25%, and the marginal standing facility, that is MSF rate, and bank rate at 6.7%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. Now, you may say that this is a status quo policy. Yes, to the extent that the rate and the stance remained unchanged, it is a status quo policy. But there are many aspects of the statement and our policy which I am going to now spell out, which will reflect, which will reveal and give an idea about our approach not only to monetary policy but also to various aspects of monetary policy as we move forward during this amidst this global challenges and headwinds. I shall now briefly set out the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation has surged in July, driven by tomato and other vegetable prices. It corrected partly in August and is expected to see further easing in September on the back of moderation of these prices. A silver lining amidst all these is declining core inflation, that is CPI inflation excluding food and fuel. The overall inflation outlook, however, is clouded by uncertainties from the fall in Kharif sowing for certain key crops like pulses and oilseeds, lower reservoir levels, and volatile global food and energy prices. The MPC observed that the recurring incidence of large and overlapping food price shocks can impart generalization and persistence to headline inflation. Economic activity, on the other hand, has remained resilient. Taking into account the evolving inflation growth dynamics and the cumulative policy repo rate hike of 250 basis points, which is still working through the economy, the MPC decided to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC. The transmission of the 250 basis points increase in the policy repo rate to bank lending and deposit rates is still incomplete, and hence the MPC decided to remain focused on withdrawal of accommodation. The MPC remains highly alert and prepared to undertake timely policy measures as may be necessary in order to align inflation to the target and anchor inflation expectations. I would now like to provide an assessment of the growth and inflation scenario. To begin with, global growth. Let me turn to a detailed assessment of the growth and inflation dynamics, starting with the external environment. As I just mentioned, the global economy is slowing under the impact of tight financial conditions, protracted geopolitical tensions, and increasing geoeconomic fragmentation. Global trade is contracting. Headline inflation is easing but rules above the target in major economies. While major central banks are signaling a peaking of their rate hike cycle, there are indications that the tight monetary policy stance could persist for longer than anticipated earlier. Sovereign bond yields have firmed up, the US dollar has appreciated, and global equity markets have corrected. Coming to domestic growth, in contrast to global trends, domestic economic activity exhibits resilience on the back of strong demand, that is, strong domestic demand. The momentum in agricultural activity in the second quarter of this financial year, that is 23-24, has been sustained, although the monsoon has been somewhat uneven. The acreage under Kharif crops as on September 29 was 0.2% above the last year's level. The industrial sector extended recovery in the second quarter. Manufacturing sector gained ground in July and August, supported by key sectors such as pharmaceuticals, basic metals, cement, motor vehicles, and food products and beverages. The Purchasing Managers Index, that is PMI for manufacturing, remained robust in September also. Services sector activity is maintaining buoyancy as indicated by healthy expansion in high-frequency indicators in August and September. PMI services, the data of which was just released yesterday, has exhibited strong expansion in September. Construction activity continues to be strong. Investment activity maintained its momentum with good support from government capex. Private sector capex is gaining ground as suggested by expansion in production and imports of capital goods and new projects sanctioned by the banks. Capacity utilization in the manufacturing sector on a seasonally adjusted basis continued to trend up, which augurs well for investment activity. The total flow of resources to the commercial sector from banks and other sources taken together at rupees 10.6 lakh crore during the current financial year so far is higher than that of last year. Merchandise exports and non-oil, non-gold imports, however, contracted though at a moderated pace in August. Services exports expanded at a healthy pace. Now, what I have done is, I have given lot of data points in the footnote of my statement, and those of you who are interested may refer to the statement. So whatever statement, whatever I am saying here is backed up by the data points which would justify the statements that I am making. So I would suggest that if there is interest, you may refer to the footnotes which are part of my statement. Now let me move on. On the demand side, steady expansion is seen in urban consumption, while rural demand is showing signs of revival. Looking ahead, domestic demand conditions are likely to benefit from sustained buoyancy in services, consumer and business optimism, government's continued thrust on capex, healthy balance sheets of banks and corporates, and supply chain normalization. Headwinds from geopolitical tensions and geoeconomic fragmentation, volatility in global financial markets, global economic slowdown, and uneven monsoon, however, pose risks to the outlook. Taking all these factors into consideration, real GDP growth for the current financial year, that is 2023-24, is projected at 6.5%, with Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. The risks are evenly balanced. Real GDP growth for the first quarter of next financial year, that is 24-25, is projected at 6.6%. Now, I said that economic activity continues to be resilient, and this is precisely what I was hinting at this is precisely what I was referring to when I said that please have a look at the footnotes. The data points will justify that statement, why we are saying that economic activity continues to be resilient and why we are projecting the current year GDP growth to be 6.5%. I would now like to focus on inflation. The heightened inflation levels in July and August at 7.4% and 6.8% respectively were largely driven by food price pressures. Vegetables, with a weight of around 6% in CPI basket, contributed to about 1/3 of CPI headline inflation in July and to around 1/4 of overall inflation in the month of August. Sustained inflationary pressures in cereals, pulses and spices added to the overall food inflation. On the positive side, core inflation softened to 4.9% during July and August. It has eased by around 140 basis points, 140. It has eased by around, that is, core inflation has eased by around 140 basis points from its recent peak in January 2023. Further disinflation of the core component is critical for price stability. As evident from our survey, there is further progress on anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic. Now, this is a part of the surveys which we have done, so let me repeat this sentence for better clarity. As evident from our survey, there is further progress in anchoring of inflation expectations, which entered single-digit zone for the first time since COVID-19 pandemic, and the numbers are given in the footnote. While near-term inflation is expected to soften on the back of vegetable price correction, especially in tomatoes, and the reduction in LPG prices, the future trajectory will be conditioned by a number of factors. For Kharif crops, the area sown under pulses is below the level a year ago. Kharif onion production also needs to be watched closely. Demand-supply mismatches in spices are likely to keep these prices at elevated levels. The inflation trajectory will also be shaped by the El Nino conditions and global food and energy prices. In fact, global food and energy prices, if you see, over the last several months, they have been considerably volatile and they require careful monitoring, but that imparts further uncertainty to the inflation outlook. Taking into account all these factors, CPI inflation is projected at 5.4% 4%. That is same as what we had projected earlier. And if there are questions, we will explain it during the press conference that follows usually my statement. Now, taking into account these factors, CPI inflation is projected at 5.4% for 23-24, with second quarter, that is Q2 at 6.4%, Q3 at 5.6%, and Q4 at 5.2%. The risks are evenly balanced. CPI inflation for the first quarter of next financial year, that is 24-25, is projected at 5.2%. Now, what do these inflation and growth conditions mean for monetary policy? Let me try and answer. Over the last 1.5 years, monetary policy actions broadly included compression of excess liquidity in the system, increase in policy repo rate by 250 basis points, and change in policy stance to withdrawal of accommodation to keep inflation expectations anchored and break the stickiness of core inflation. Complementing these measures were proactive supply-side interventions by the government to improve domestic availability of key food items and reduce input costs. Consequently, headline inflation moderated to 4.6% in the first quarter of the current financial year, that is from April, May and June of the current financial year 23-24, as compared to 7.3% in the first quarter of last year. So last year in the first quarter it was 7.3%. This year in the first quarter the headline inflation moderated to 4.6%. A significant easing of inflation pressures from its exceptionally high level in July and August is expected to materialize in September as the impact of fleeting food price shocks wane. Further, underlying inflation pressures are also moderating while the impact of past monetary policy actions is still unfolding. Even so, indications are that throughout much of the third quarter of the current financial year, food inflation pressures may not see much easing, or rather may not see sustained easing. External factors like energy prices and financial market conditions continue to be volatile. All these call for careful monitoring of the incoming data and the outlook. That is, we have to monitor not only the incoming data but also the build-up of the future, the outlook, to clearly delineate the durable components of price shocks from its transitory elements. Monetary policy has to be in absolute readiness to take appropriate and timely action to prevent any spillovers from food and fuel price shocks to underlying inflation trends and risks to anchoring of inflation expectations. These are non-negotiable necessities. I would now like to turn to liquidity and financial market conditions. As I have reiterated several times in my previous policy statements, excessive liquidity can pose risks to both price and financial stability. To ensure that liquidity conditions evolve in sync with the monetary policy stance, the Reserve Bank, as a temporary measure, had imposed an incremental cash reserve ratio, that is ICRR, of 10%, which impounded about rupees 1.1 lakh crore from the banking system. The ICRR was reviewed on September 8th and is being discontinued in a phased manner ending October 7th, that is tomorrow. Moderation in excess liquidity conditions as a result of the combined impact of ICRR and advance tax outflows in September has resulted in greater recourse to marginal standing facility, that is MSF, by the banks. Elevated levels of MSF borrowings amidst substantial funds parked under the standing deposit facility is symptomatic of skewed liquidity distribution in the banking system. So what's happening is that a set of banks, they are depositing in the SDF every day more than 1 lakh crores. Sometimes it exceeds 1.5 lakh crores. At the same time, there are other banks which are borrowing from the marginal standing facility of the Reserve Bank of an equivalent amount. So obviously the distribution of liquidity in the banking system is skewed. This got reflected in the firming up of weighted average call rate, that is WACR, which is the operating target of monetary policy. Despite such hardening at the short end of the term structure, the average term spread in G-Secs in the government securities market, that is 10-year minus 91-day T-bills, remained at around 40 basis points in August and September, suggesting stable financial conditions. In recent months, banks have preferred to place funds under the overnight SDF instead of offering them in the main 14-day variable rate reverse repo operations, that is VRRR operations. It is imperative that banks assess their actual liquidity requirements over the reserve maintenance cycle and bid accordingly in the auctions under the main 14-day VRR operations of the Reserve Bank. It is desirable that banks having surplus funds explore lending opportunities in the interbank call market rather than passively parking funds in the SDF at relatively less attractive rates. Greater volume of call money transactions would not only help in deepening the interbank money market but also lower the recourse of deficit banks to the MSF. The release of the remaining impounded ICRR funds tomorrow, along with pickup in government spending, are expected to ease liquidity conditions. Festival time increase in currency demand may of course act as a counterbalancing factor. It's a turning pitch and we will play our shots very carefully. Going forward, while remaining nimble, we may have to consider OMO sales, that is open market sales of government securities, to manage liquidity consistent with the stance of monetary policy. The timing and quantum of such operations will depend on the evolving liquidity conditions. I would now like to touch upon financial stability. The Indian banking system continues to be resilient, backed by improved asset quality, stable credit growth and robust earnings growth. The credit growth is broad-based and backed by strong fundamentals of the financial institutions. The financial indicators of the non-banking financial companies are also in line with that of the banking system as per the latest data available for June. Certain components of personal loans are, however, recording very high growth. These are being closely monitored by the Reserve Bank for any signs of incipient stress. Banks and NBFCs would be well advised to strengthen their internal surveillance mechanisms, address the buildup of risks, if any, and institute suitable safeguards in their own interest. The need of the hour is robust risk management and stronger underwriting standards. The global financial landscape is rapidly changing and potential stress may emerge from unanticipated corners. The Reserve Bank is closely monitoring the evolving situation and will act proactively to maintain financial stability. I would now like to touch upon the external sector. India's merchandise exports and imports have remained in contractionary zone so far during 23-24, although at a decelerated pace during July and August. Services exports grew at a healthy pace in the first quarter of this year and remained strong during July and August also, driven by software and business services. Inward remittances have risen by 5.8% year on year. The current account deficit for the first quarter of the current financial year 23-24 declined to 1.1% of GDP from a year ago. There was an accretion of US dollar 24.4 billion to foreign exchange reserves on balance of payments basis during the first quarter of this current financial year. On external financing, foreign portfolio investment, that is FPI flows, have seen a significant turnaround in 2023-24 with net FPI inflows at US dollar 20.3 billion up to September of this year, as against net outflow in the preceding 2 years. Net foreign direct investment, on the other hand, moderated to 5.8 billion US dollars in April to July from $17.3 billion a year ago. The inflows under external commercial borrowings, that is ECBs, witnessed a turnaround with net inflows of 4.5 billion US dollars during April-August this year, as against net outflows of 3.2 billion a year ago. The number and total amount of ECB agreements grew markedly during April to August this year, with about 60% of the total amount being raised for capital expenditure. External vulnerability indicators also indicate lower vulnerability in comparison with EME peers. India's foreign exchange reserves stood at 586.9 billion as on September 29 this year. We remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first one relates to prudential framework for income recognition, asset classification and provisioning pertaining to advances, particularly in the context of projects under implementation. With a view to strengthen the extant regulatory framework governing project finance and to harmonize the instructions across all regulated entities, the existing prudential norms for projects under implementation have been reviewed. A comprehensive regulatory framework applicable for all regulated entities is now proposed to be issued. Detailed draft guidelines will be released for public comments. The next announcement relates to credit concentration norms, credit risk transfer, and this is in the context of the NBFCs. At present, under the large exposure framework, NBFCs in the upper layer are permitted to use credit risk mitigation instruments for reducing their exposures to a counterparty. With a view to harmonize the credit concentration norms among the NBFCs, it has been decided to also permit NBFCs in the middle and base layers to use the credit risk mitigation instruments for reducing their counterparty exposures under the credit concentration norms. The next announcement relates to gold loan bullet repayment scheme in respect of the urban cooperative banks, that is UCBs. It has been decided to increase the existing limit for gold loans under the bullet repayment scheme from rupees 2 lakh to rupees 4 lakh in respect of urban cooperative banks who have met the overall target and sub-targets under the priority sector lending as on 31st March 2023. This measure is in pursuance of our earlier announcement that suitable incentives shall be provided to the UCBs that have met the prescribed priority sector lending targets as on 31st March 2023. The next announcement relates to framework for recognition of self-regulatory organizations, that is SROs for regulated entities of the Reserve Bank. Self-regulatory organizations can play an important role in strengthening compliance culture among their members and also provide a consultative platform with the Reserve Bank for policy making. Therefore, it has been decided to issue a draft omnibus framework for recognizing the self-regulatory organizations, that is the SROs, for various categories of regulated entities of the Reserve Bank. And these draft guidelines will be issued for stakeholder comments. Additional sector-specific conditions may also be prescribed at the time of calling for applications. The next announcement is with regard to Payments Infrastructure Development Fund, that is PIDF, and we are extending this coverage of this scheme and including the Prime Minister's Vishwakarma scheme beneficiaries also. Since its launch in January 2021, the Payments Infrastructure Development Fund, that is the PIDF scheme, has enabled over 2.66 crore. I repeat, the PIDF scheme since its launch in January 2021 has enabled over 2.66 crore new payment touch points across the country. It has been decided to extend the scheme by 2 years, that is up to December 31st, 2025. The coverage of the PIDF scheme is also being expanded, number one, to include the beneficiaries under the Prime Minister's Vishwakarma scheme, and number two, to deploy emerging modes of payment acceptance such as Soundbox and Aadhaar-enabled biometric payment acceptance devices. These measures will further accelerate the Reserve Bank's efforts to promote digital payments at the grassroots level. The next announcement relates to introduction of new channels for card-on-file tokenization, that is COFT. Given the growing acceptance and benefits of tokenization of card data, it is now proposed to introduce card-on-file tokenization creation facilities directly at the issue bank level. This measure will enhance convenience for cardholders to get tokens created and linked to their existing accounts with various e-commerce applications. And the final announcement is as follows, after which I will conclude. The last announcement relates to master direction on internal ombudsman mechanism in the regulated entities. You would have noticed that over the recent years, we have taken a number of measures to improve the system of customers' grievance redressal in the banks as well as in the NBFCs and other entities which are regulated by the Reserve Bank. Now, at present, we have also mandated, as you know, there is an integrated ombudsman scheme of the Reserve Bank, but before that, there is an internal ombudsman scheme in the regulated entities, be it NBFCs or banks. Now, at present, internal ombudsman framework in regulated entities comprises of separate guidelines for select scheduled commercial banks, non-bank issuers of prepaid instruments, NBFCs and all credit information companies, that is CICs. These guidelines have similar design features but vary in certain operational aspects. It has been decided to effect certain changes and also consolidate and harmonize the internal ombudsman guidelines into a single master direction. This will further strengthen the customer grievance redress system of the regulated entities. Now, I am referring here to the internal ombudsman scheme which every bank, every NBFC, every regulated entity is expected to have, and they do have it. We are further fine-tuning that system so that customer grievance redress mechanism improves further. Let me now conclude. The Indian economy is forging ahead in a challenging global environment, drawing strength from its underlying macroeconomic fundamentals and buffers. While growth remains on track, the declining trend in inflation was interrupted in July and August due to price shocks in certain food items. Volatile energy and food prices in the wake of lingering geopolitical tensions and adverse weather conditions render uncertainty to the inflation outlook. We remain vigilant of the evolving inflation dynamics. I would like to emphatically reiterate, let me repeat, I would like to emphatically reiterate that our inflation target is 4% and not 2 to 6%. Our aim is to align inflation to the target on a durable basis while supporting growth. Our commitment to ensure financial stability reinforces our emphasis on price stability and anchoring of inflation expectations. This would keep inflation risk premium low and improve our competitiveness, productivity, and growth potential. As we continue our journey ahead, we take inspiration from Mahatma Gandhi's profound words, and I quote, "If we keep that as our goal, we shall never despond, we shall never weaken, and we shall ever go forward." Thank you. Namaskar.
Yeah, RBI policy meet outcome. It's a fine print, and what the RBI governor has done is he has largely stuck to the script. But there is a positive surprise given the fact that we have maintained that FY24 inflation forecast to 5.4%, and that's a positive because the street, in fact, economists also were expecting the RBI to revise the forecast upwards to somewhere around 5.5 to 5.6%. But what he has done, of course, is that he has maintained it at 5.4%. He has in fact increased the Q2 estimate to 6.4%, and he has decreased the Q3 estimate by a couple of basis points as well. But stuck to the script. Rates have been kept on hold. Stance is withdrawal of accommodation, and even on the liquidity front, he hasn't really announced of ICR kind of a
we
measure.
were hoping that there would be some kind of
liquidity measure announced by the governor, but that hasn't happened. He's in fact said that he will take recourse or will consider OMOs to suck out excess liquidity or manage liquidity in the system. So that is the big takeaway, Stacey. Aside of that, on the liquidity front, he's made a very interesting point, saying that it is a turning pitch and they will play their shots accordingly. Given the fact that they have RBI governor also mentioned that the banks have taken higher usage of the marginal standing facility to bridge the liquidity gap, and that's something that that stood out as well. But let's also try and introduce our guests on the panel today. Do we have any guests joining in right now? All right, Aditi Nair, who's the chief economist and head research at ICRA, is joining in at this juncture. Hi Aditi, great to have you on the show. Let me first ask you your thoughts on what the governor's announcement has been on the rate front and on the stance front. There is no surprise, but a positive surprise when it comes to the inflation forecast for FY24. And of course, what will you call his tone this time around? Hawkish, or would you say it is vigilant?
So yeah, absolutely no surprises as far as the status quo on the rates and the stance is concerned. And also in line with what we were expecting, no change in the GDP forecast or the overall full year inflation forecast, although for 2 of the quarters there has been a tweak, but we were at 5.4% for the full year as well. And so this is in line with the expectations. Now, going ahead, obviously, as expected, he has highlighted all of the sources of concern on inflation and talked about, the fact that we need to make sure that they don't generalize and become persistent. So I don't know if you want to call it vigilant. I think vigilance is a given at all times with the central bank. So I would still say that it's expectedly hawkish in the commentary. Big surprise, of course, was the very clear comment on OMO sales. So I would say that is something that was not really expected, which is a little bit different, which is coming in today's policy, but otherwise pretty much along expected lines.
Right. So pretty much along expected lines. We knew this was what we were expecting, or you have none status quo, and what he said was also there's a fact that it is perhaps he's going to wait and watch, and that's what we're doing for some time now. But let me also bring in Jaideep Iyer, the head strategy at RBL Bank. Jaideep, your first assessment of how you're looking at it, what could be the other factors that he has pretty much laid it all out there on what are the ones that they are considering could be changing the situation, be it El Nino, be it the Kharif sowing. But what, according to you, should be the points that we should be focusing on going ahead?
No, I think clearly, I think it's going to be a close monitoring by RBI, and he was very, very clear that if there are signs of food inflation getting into core inflation, and if there are worries that inflation is going to be a little sticky or trickier, I think they will take action. In fact, he made it very clear that the inflation target is not 2 to 6%. The inflation target is 4%. So clearly, I think the risks are tilted towards maybe another hike at some point, but definitely a very, very long pause. I don't think we are seeing cuts for some time.
Right. Jaideep, on the liquidity situation only that we're talking about, ICRR is also being discontinued in a phased manner, tomorrow being the last one. But he did mention OMO sales. So is this the route to be taking, or were there other options that he could have chose for?
No, so ICRR came in because of the peculiar situation of the 2000 rupee notes, right? Which ended up having a significant surplus liquidity in the system. I think OMOs are a lot more flexible. You can do it as and when you want to absorb, short-term excess liquidities. I think it is very clear that the RBI will want to maintain liquidity in the neutral to negative zone. We continue to see largely the overnight rates, which are typically 20-25 basis points higher than the repo rate. Purely from a banking system standpoint, honestly, banks would be okay to have a repo rate hike as long as the liquidity is neutral, because the repo rate hike does translate into increase in loan yields, and which is good for the banking sector. But I think clearly the RBI is going to be very, very nimble in terms of ensuring liquidity is neutral to negative. I think they have to also have a eye on the dollar rupee, because dollar is strengthened globally. Luckily, there was not much of a discussion on long-term bond yields or US rates. He did mention. So one of the challenges we will have is that there will be some kind of a floor on 10-year India rates, because you can't have spreads which narrow significantly from US 10 years to India 10 year. So I guess, I think from a flexibility standpoint, it is good if OMO is used rather than having any medium-term measures on liquidity.
All right, we'll talk about the rate differentials in details in a bit, but let me also bring on board Aishwarya Dadhij, who's the market expert, joining in today. Good morning, Aishwarya. Great to have you on the show. The markets haven't really moved anywhere. We are exactly where we were right before the governor's announcement, right? So would you say that policies have become more like a non-event for the markets? And but if you see, markets have been holding steady, and we have reclaimed that 19,600 mark today. So we are showing resilience, but going forward, where do you expect the markets to head from here?
Good morning, everybody, and thank you for having me here. I think beautifully said, when market is able to discount what the central bank is about to do, that's the best, job done. So market was already discounting that this will be a status quo. And the only fear that market had was, possibly some mechanism or some announcement on liquidity. So apart from the OMO sales, which was announced, there is not much change either on the inflation targeting and possibly even on the GDP number. So I think market is rejoicing that. So no news is more or less is a positive news is what, street is expecting. Another thing, which I have taken off from the, chairman's speech is, when he mentioned about that 4% rather than from 2 to 6%. So the growth is very much solid with all the data that he has shared. And even on the inflation side, we haven't seen much of a, concern. But this ability, his intentions to lower the inflation forward is something which possibly market will rejoice in the coming time. So given the global backdrop, the external factors, if you see the last policy and this policy, we have seen almost, more than 100 bips increase in US 10-year yield, whereas India has hardly inched up anything from not more than 20-30 bips. So that external risk persists, and, we will yet to see whether Fed will do another rate hike this calendar year. RBI will be very, very vigilant on his next case of action. So market possibly expect that no rate hike would be very, very conducive for the growth part and for the equity market part, but we have to watch in tandem with what the Fed does.
Right. Right, Aishwarya, what's the assessment on banks? I mean, banks as a pocket has underperformed quite a bit. But as we enter the earnings season, would you expect the underperformance to continue? And what will you be watching out for? Of course, margins could be could be under pressure for banks because Street believes that the best of the margin performance may be over for banks for now. So, from this particular pocket, how should one view it now entering into the earnings season?
If you look at, we're just entering the quarterly season, and if you have seen many of those banks coming out with their quarterly updates, and so far, we haven't seen any big negative news across the banks that they've reported. The credit growth is pretty sanguine. There is some concern on NIM compression because we have seen that CASA has been under pressure for the last couple of months. But we believe overall banking as a sector should do well on growth part. And on the equity prices of the majority of this bank and NBFC, we should not forget that large part of easy money making has already been done in banks and NBFCs. So, the investors have to be very careful in allocating their money into those banks and NBFCs which are able to show consistent growth, where balance sheets and ALM are better shaped, and possibly where the risk on asset quality is very low. So we don't expect a very, I would say, quick movement across banking depending on the quarterly season, because the quarterly seasons are expected to be on expected lines rather than any, one-off thing here or there on asset quality, which could be a big negative surprise. But banking should remain a part of the equity investors' portfolio for coming at least quarters.
Right, let me go across to Aditi then. Aditi, wanted to know your view on all that we are seeing transpire when it comes to the bond yields, those surging bond yields. Though now in the past 2 days, a little bit of retreat that we saw, but how is that really impacting the markets? We've seen equities have suffered quite a bit because of that, but going ahead, is this what we're likely to see?
I think what we've seen in the US market with what's happening with yields over there, of course, that is a factor that we can't ignore. And at the same time, we had this big spike in crude oil, which has thankfully retreated a little bit. Now, for India, crude oil prices are really very meaningful because we're a big importer, and this is a big part of our overall merchandise trade deficit. So typically, that is something that yields should be reacting to quite a lot as well. Now that sort of transient stress is behind us, I think unless we have a big shock event, possibly yields are going to remain in this range of, let's say, between 720 and 730 for the next couple of months. But if there is some event which is particularly negative, then we could see yields breaking out into a higher range. For example, if crude was to, even if it's temporarily, move above $100 per barrel, that is definitely something that could move yields out of this range. But barring a shock like that, we do think that for some reason yields are just stuck in this range that we are seeing right now.
But Aditi, we have seen a reprieve, as you mentioned, in crude prices as well. In 1 week, crude prices have eased nearly $13 to $14, right? But do you think this reprieve is temporary? Given the fact that, of course, supply will remain, constrained at least till December. Demand worries are there, but the kind of volatility we have seen in crude prices, do you think that a retest could be possible of $100? And should RBI now work with a higher level instead of $85 that it's working with?
So I'm not an expert on crude oil by any means, but as an economist, I'll just share a few of my observations. I'm not sure that the world economy can remain in equilibrium if oil sustains above $100 a barrel for an extended period of time. It is going to have an impact on demand. And at the same time, we can't rule out the fact that it could test $100 every now and then, which it does. Definitely that is not a scenario that we can rule out. At the same time, prices are not going to fall too much, given how tightly supply is controlled. We have to broadly be prepared for crude to be in an $80 to $90 per barrel range for most of the year ahead. If we have prices lower than that, that's a bonus. At ICRA, for instance, we have now reworked our H2 current account deficit forecast to take in crude oil at $90 per barrel. And with that, we are looking at a current account deficit of 2.1% of GDP, which is not anywhere near alarming levels. But yes, we have somewhat revised up our full year current account deficit forecast to about 2.1% of GDP. Now, Coming back to yield, the other big factor that typically influences our domestic yield is the fiscal concerns. And when we look at Government of India's finances, there are some sources of worry, but there are also some areas where we feel that the revenues may be quite comfortable. So overall, we think that it's a very balanced situation, and we're not very concerned overall on the yields from the fiscal point.
All right. Coming to you, Jaideep, the rate transmission is still taking place. Of course, even the governor has mentioned that. But do you envisage any changes in deposit or lending rates post this policy from a banker's perspective?
No, I think the lending rates have kind of, at least the large part of retail book for most banks are now linked to repo rate. So, you really don't have much of a choice there. That transmission happens pretty much immediately. I think on the deposit side, we might still have some more follow through because deposit market is also getting more competitive, and we might see some increase in rates from banks on the deposit side.
Right. Aishwarya, let me get you in. The other big point that we'll be looking forward to going ahead is the jobs data that is expected out of the US today, and pretty much that will also give a Fed some bit of direction in its next policy. And we don't really mirror, but that is what has been happening of late. So do you think markets in the US are also waiting for this kind of data? But we are seeing not much reaction here in our own markets, but if you have to follow what is happening overseas, is there some kind of correlation that we can see or a boost that we can see from US equities, and that also translating to what we can see here in India?
Definitely. So obviously we are not, we don't work in solidarity, and whatever happens in US obviously have a colloquial impact across other markets and geographies. But one thing which clearly stands out is the way how Indian economy has been showing resilience over the last 3-4 quarters. If you look at the growth rate, if you look at the various high frequency macroeconomic indicators, there is a very inherent strength which India is running on, and which is what is supporting, even if you look at our 10-year or our currency, the growth is very, very an important contributor factor. Second, obviously, we have heard about the JPM index and other various parameters, which will provide liquidity and inflows, and which also support this 10-year and even also this, currency from that perspective. But obviously, if you see, that there will be, any good news comes out of those employment data, there's again a possibility of, yield hardening in US, and possibly again, pressure on equity market will be reflected in the Indian market also. But if you look at the last month, which was September, the kind of flows we have seen both in the cash market as well as even in the future markets, the ability of Indian market to absorb this outflows is remarkable. There has been a continuous inflows of domestic money which is holding up the market, and I can tell you, if there is any clarity which comes through about that, either that would be the last hike which Fed will possibly do, or it is at the end of the rate hike cycle, Indian market can really surprise on the upside, as given I was talking to you about the economic strength as well as our other factors which are there. So we are very watchful of what US does, but India is completely writing a different story.
Right, Aditi, coming to you, of course, we've recently had the announcement of Indian bond inclusion in the JP Morgan EM bond index, and that could, of course, lead to massive inflows of somewhere around $20 to $30 billion, even active flows of somewhere around $10 billion or thereabouts. But that's only from June 2024. Right now, the differentials, the rate differentials between US bond yields and Indian bond yields are reducing. How would that impact dollar flows into the country at this current juncture, and should RBI be worried right now about it?
So a couple of things, like you rightly pointed out, those inflows are only going to come in next year. So it's not actually going to impact yields right away. And yields are much lower than what we've seen over the last few years at this point in time. So clearly, there's no space for yields to compress, the spread to compress further. If anything, possibly the market will be looking for reasons to correct the spread to some extent. Now, whether that's going to come in simply because the US yields retreat a little, or is it going to mean that the Indian yields have to go up, or are they going to stay flat where they are despite the fact that the bond index inclusion is in the foreseeable future? Of it is still a few quarters away. Now, to my mind, like I was saying earlier, there would have to be some really negative news to push yields, the Indian 10-year yield, for example, out of this very narrow range that we're seeing right now. At the same time, for the current period, we don't expect there to be too much of outflow on the debt side just because the spreads are so compressed. So I think we can live in this sort of range for a little bit longer, even though the spreads are quite compressed right now, because we do know that 3 quarters down the road, these inflows are likely to start given the bond index increase.
Right, Aditi, very quickly I want to ask you, of course, last time when we spoke about, the RBI's rate cut timeline, things have changed since then, given the fact that Fed has indicated fewer rate cuts for next year, right? Does that push the rate cut timeline for us as well? What are your own thoughts?
Look, I still think rate cuts are highly unlikely from the MPC before August of next year. And even when the rate cut cycle starts, it's unlikely to be more than 50 to 75 basis points. So it's going to be a very shallow cycle as it is. And we're not expecting this to come in anytime soon. See, today we didn't get any subsequent quarter inflation projection from the MPC. So the last quarter remains Q1 at 5.2%, which is what they had indicated last time as well. And unless we get this clarity that inflation is going to fall into the 4% handle and remain in the 4% handle for an extended period of time, I don't think that the MPC is going to start considering rate cuts. So that's our continued view that August 2024 is the earliest that we can expect a rate cut.
Right. Jaideep, maybe I'll come to you, and I want to get your view on the other announcement that came in terms of gold loans and also loans in general for banks that could be a concern. That's what the governor also pointed out, the unsecured loans that they're seeing quite a spike in that. So your view on that, and also what they're trying to do with gold. We are seeing gold prices reduce. Is that turning to be that safe haven once again, and especially with this limit that they've increased now, just in time with the festive season? How is all of that auguring in for gold as an asset?
Yeah, so I think from a banking standpoint, I think gold loans have been a good growth area for most banks. It is considered relatively safe lending. It is operationally intensive, no doubt, but that's something which we've seen growth. And I think that will continue as long as there is comfort on gold prices. And I don't think, given the environment, we will have bearish view on gold. Similarly, I think on the unsecured loans, yes, there have been comments by the Reserve Bank publicly on the fact that there is some level of concern on the growth in unsecured loans. And I think banks do recognize that. And we've seen some let's say early signs of stress in the low ticket size in the industry, not for us as much, but in the industry where very small ticket personal loans and unsecured loans do seem to be showing high delinquency. And I think the Reserve Bank is quite clear in its public as well as private communication to banks that one should be wary of this and put in appropriate measures in place from a risk mitigation standpoint and so on and so forth. So I think we will continue to see growth in personal loans and credit cards, but I think we could see some moderation in terms of growth coming there. But I think gold will continue to grow.
There are reports that government is considering spending somewhere around 60,000 crores to provide subsidized loans for small urban housing segment over the next 5 years or so, and banks are likely to roll out this scheme somewhere perhaps in a couple of months ahead of state elections and even the general elections. How will that impact the overall demand for home loan growth, and how are things as of now? How do they stand now?
Sorry, that's a question to me?
Yes, Jaideep, that's for you.
Yeah, sorry. Yeah, so I think we've seen some moderation in home loan demand because rates went up quite substantially. And I think one of the worries that the system will have is that I don't think there is a 25 basis point problem, but if there is a 50, 75 basis point increase in repo rate hike, and I'm not suggesting that will happen, but then there will be demand as well as stress coming in home loan segments because EMIs will expand quite substantially. I think on the affordable home loans, I think the government has done a very, very good job. And I think banks have taken benefit of the fact that the subsidy allows the borrower to take a higher loan at a higher rate from a bank standpoint, but the government subsidy allows them to take that loan. And I think that it is a good thing because there is India is still highly under housed. I mean, there is enough and more housing that needs to come up. As of now, what we are seeing is that affordable home loans demand has come off a little bit, and prime housing is still strong, especially in metros and urban areas. But any government schemes and Philips will definitely allow banks and probably even NBFCs, more importantly, to be able to tap that demand.
I also want to get in your thoughts on what you will be expecting from the governor's press conference at 12 p.m. later today. Any announcements you are expecting in terms of banking license, fintech regulations, anything of that sort?
No, I think that will most likely be done through the Reserve Bank of India, especially on the fintech side. Banking license is very unlikely. I mean, I don't think I'm going to hazard a guess on that. No.
Right. Aishwarya, maybe you can come in now. We did speak about how, there's not much that we've seen change in terms of loans and EMIs because of the status quo, at least in the 4 consecutive sessions so far. But what about the sectors? How are those ones reacting? All of these rate sensitives, we've been seeing quite some swings when it comes to auto, especially, also even construction and that side. Cement has been doing, on and off, seeing those swings. So what about these sectors, and how do you see stocks in them really reacting?
I think most of these rate sensitive sectors will take a breather because especially if you look at real estate, which has been, as what was discussed, that the EMIs and things are going up, which is creating pressure on consumer spending, and possibly as long as the rate stays high, or at least for the next 6-9 months before we see any rate cut anytime soon. This will become slightly difficult for real estate companies and auto companies to really, see their growth touching new highs. Auto is anyway relatively doing well, but the real estate is one sector which is, feeling the pinch because the EMI percentage as a payout has gone up almost by 250 to 300 bps for individual, loan borrowers. That is what is creating pressure on them. Even if you look at majority of the infrastructure or investment done on the private capex side, also take a backseat when interest rate goes high. This is also happening in US and possibly India, who is also seeing, a dichotomy in promoters' mindset that obviously the growth is there, but do it really makes sense to, borrow money at this rate for capex when, interest rate is at much higher level. So I think this is a very fine balance where most of those borrowers are on thinking lines and also impacting the consumer. I think the biggest low-hanging benefit will come to them when we will see a reversal in interest rate anytime soon, possibly by the end of the next calendar year.
Right. Let me also bring on board market expert Ajay Bagga joining in this afternoon. Thanks a lot, Mr. Bagga, as usual, for joining in. I want to get in your first reading of, the RBI governor's comments because, of course, when it comes to policy, no big surprises there. But one positive surprise is that, FY24 inflation forecast has been left unchanged prior to what the street was expecting. What are your thoughts?
Yeah, the maths doesn't work out. If July was 7.4 and August was 6.8, then September has to be below 5% to meet this quarterly 6.4. So I don't know how September will be 5 or below CPI. So that was the only surprise. We were expecting inflation for the year to be hiked by about 10 basis points. They've held it constant. That's good. The bond market is skeptical, Nandita. That's why you saw the bond yields going up. They're not believing this inflation number. But otherwise, a hawkish pause policy. The stance stays restriction of accommodative stance and a withdrawal of accommodation. So restrictive stance stays. Rates stay constant, GDP stays constant. That's as per expectation. The only surprise was inflation not being raised, and especially a 20 basis point hike in this quarter's number. I think that's underballed. It will be tough to meet this 6.4 for this quarter. September can't come below 5%. That's the estimate.
All right, that's of course tough to meet the Q2 estimates as you mentioned. Hold that thought, Ajay. We'll come back to you and talk about more stocks and sectors. But let me also bring on board Lata Venkatesh of CNBC TV 18 joining in. Lata ma'am, yesterday when we were talking, you said the walk will be more important than the talk. What do you make of the walk or the talk rather, given the fact that we weren't expecting the RBI to maintain the FY24 inflation forecast. Aside of that, what were the key takeaways for you from the governor's speech?
No, that is a bit of a surprise, because if you want to get 6.4 average for July, August, September, then you have to do 4.95 for the month of September. If you add August and July, you're getting about 14.2, and to achieve that 6.4 you have to get 4.95. Maybe it will come at 5, so perhaps it's just a little more, maybe it is 6.45 average. I would give them the benefit of doubt on that, but the fact that they have not increased the full year as well shows a bit of confidence that vegetable prices are down, and core, I think they're very positive that core will come down. I would take that as a dovish sign. I would take it also as a dovish sign that for next year, it's not a hard and fast forecast because it has come in the monetary policy report. The monetary policy report is a backgrounder which all inflation targeting central banks have to release twice. They released it in April, now it is in September. They are giving us the year ahead forecast for inflation, and they have kept it at 4.3. Originally they said 4.4. This 4.3 is a fairly dovish number, and that can lead to expectations of rate cut at some point next year. And even they're expecting inflation to go in a range of 3.8 to 5.2. That's fairly benign, and therefore rate cut expectations can come. But at the moment, the bond market is not penciling in anything because of the big announcement that we will do open market sales of bonds. What happens when you sell a bond? You are taking away liquidity from the banking system. When you take away liquidity, the banks have to work harder and try to get deposit from you and me. So deposit rates go up. First, the interbank call rate goes up. When the interbank call rate, that is the rate at which banks borrow from one another, goes up, then all the CPs, everything attached to it, also the yields tend to get pushed up. And more importantly, if some banks are really short of cash, they will have to push up deposit rates. So that can increase both financial rates, that is rates for you and me, and interbank rates. So we have to just watch that this OMO statement, they're already doing, by the way, open market sales. They're doing it on the screen without calling for an auction. Now, do they mean that they will make open market auctions? I think that was the most hawkish statement. We are going to sell bonds, which means they're going to take out liquidity, and you could therefore see what will happen. But we don't know exactly how much and how tight. We'll have to wait and see. And the other hawkish statement was that last parting shot, if you remember, his last statement, our target is not 2 to 6. Our target is CPI at 4. Now, is he saying, therefore, rate cuts are far away till I see the, alignment towards 4? He's giving that warning. You could take those two as hawkish, but for the market, at the moment, the only important statement is that they are going to sell bonds, and therefore you saw bond yields go up.
Ma'am, give us some perspective on what we can hear from the governor now in this upcoming press conference that he's going to hold, because he pretty much laid out everything there for us on the ground. And also, like you mentioned, this OMO, there will perhaps be many questions on this, on whether they're going to take this auction route and what would that really translate into. So just give our viewers a little more details on how this could play out.
See, I have 6 questions, but they ration us into 1 question per head. So I hope somebody else will ask these questions. One would be, will you do screen based, or will you actually call for an auction and do open market, because that can be a little more tightening. The second question will be, how are you looking at the global rise in rates from an emerging market central banker perspective? More on that. He also raised the ire or the fear over unsecured personal loans going up. So will you move? At the moment they've only warned. They have not said that you have to provide more for them or increase the risk weight, keep more capital aside for these loans. Will they do that? They've given a fintech a banking license. So that is another important point. Paytm has gone up, I don't know why. But the point is, it can be interesting for the stock market and for the startup ecosystem. All these will be very important. We have to watch out what he says in terms of India's reaction to rise in yields, in terms of how he will do the OMO, in terms of whether he will move against, unsecured personal loans. It will hit NBFCs. If he says, yes, I will move, I doubt he will. But anyway, those are the things I would watch out for.
All right, Lata ma'am, with that, thanks a lot for joining in and sharing your thoughts with us. Ajay is in fact waiting by patiently. Let me go across to him and ask him, Ajay, of course, oil prices have been fairly volatile. In fact, $13 move coming in the last 1 week. US yields eased off a bit, but the signals coming out of the US job markets are fairly mixed. It's quite messy, so to say. And we have the monthly jobs report due later today. Given that, would you say that the Fed could look at say one last hike, because they haven't indicated that they are at the end of the rate hike cycle yet? And in that sense, even the governor's statement that 4% is what they are targeting, would you say rate cuts here in India, would you see them getting pushed further into, say, perhaps next year October, or in fact even later than that?
Next year, if we get to April, that's good, Nandita. We'll have to see. That is very clear. We can't move before the Fed moves. You have to protect the rupee as well. So there is no question of rate cuts before the Fed seems to be nearing a cut. And before that, the US economy has to slow down appreciably. As you said, the labor market is just holding up. It's a two-faced economy. If you see, some days the job numbers are looking very strong. Some days the ADP payroll comes in very weak. What is the basic issue out here? All these are survey based. Hardly 30% of companies are bothering to fill up these surveys on time. So you get the first cut, second cut, third cut, and by then the whole policy has changed. I mean, you had a really very surprising case of UK GDP being restated after years that they had missed out measuring some portions of the economy, and that would have changed your investment style towards the UK market if you had that information. So today's job data in the US will be messy, will be very unreliable. Less than 30% companies would have actually reported that number. The previous month's numbers have been moving. So the last 3 months numbers normally get restated, and we have seen that they have been going down. So that extrapolation that was being done on that sample out of a sample has become very unreliable. And the Fed clearly doesn't take that into account. The Fed or most of the central bankers, the difference of, say, from a Y.V. Reddy or even a Manmohan Singh or a Bimal Jalan kind of maestros, they were economists. They would give you an economic perspective. Now what has happened is central banks are being run either by politicians or bureaucrats who have gone behind a very convenient phase of saying, I am data dependent. If the central bank is data dependent, what can I do as an investor when the data changes every day and the interpretation of the data can be multifaceted, and then the data gets restated not once but 3 times? How do you think investors would be accurate in their forecasts? So very difficult task to read the tea leaves about these central banks of today. It's become very convenient to say we'll be data dependent, and that's why you're getting enhanced volatility, because markets decide that day is bad news good news, or is good news going to be bad news, or vice versa for both of them. Right. Now, ADP payrolls number, that's a very unreliable number, and that is largely coming from large caps when the when the job creation is happening on SMEs. But the markets went up because ADP payroll came at 89,000. And a month later, just you note it and keep it, this number would have changed totally. And that's why it was a short-lived rally. Again, the market came back. What is more reliable is your bond market. The bond market gives you a very good perspective, and that is flashing red. That is telling you there is trouble coming up. That's why I'm very cautious about the markets. This data, this analysis has become very difficult to do.
Right. Mr. Baga, what would you say then? Could, investors and others also look forward to as those key triggers that will really take the market forward? This one being pretty much a no-gamer now that the policy is on expected lines, and other triggers as well coming there as we're seeing it. So how should investors be looking at, if they're not looking at data, what should the markets really be looking forward to, especially if now we have the earnings season, so you're likely to say earning results and also the festive season to see that demand. So what would you be telling investors to look at then?
Investors have to come back to their own. Why are you investing? That is, you have to just go back to that and ignore the noise. There is no signal. This is noise. And not only is the policy on expected line, the policy is now dependent on the global macro, the actions of global central banks. We cannot act independently. Otherwise, in a slowing economy, you could have said, okay, let me give some relief. You have taken out, liquidity from this market right at the festival time. 40-50% of sales for the year are going to happen in the next 3 to 4 months. Small-time traders are borrowing money at 18%, 20% in the informal sector because you've taken out so much liquidity. And already banks are lending at 19%. Banks are happier lending to private individuals rather than small-time businesses, which the failure rates are much higher. So you see all that. It's not an economist central bank. It is a central bank which is very dependent on the global central banking themes and has to act according to that. So very conservatively, we have kept out banks out of any trouble on the real estate side. There might be some trouble in NBFCs. He hinted on that between the lines, and I would not be surprised because credit is not something you learn so easily, and it's very easy to open the taps, but then to recover the money is another possibility. So for investors, in short, be cautious, look at your goals, why are you investing? And if you're investing for the next 20-30 years, keep investing that regular amount every month. Don't look at what's happening in the Fed or what will happen in US payrolls this evening. All that is irrelevant for you. So long as you are diversified, you're in good quality companies for the long term, and you stay invested, keep shoveling in as much as you can into your investments and then just hold tight. That is the best mantra for the retailers, and that's how they make solid money. The SIPs of India are the ones making the money. Well, it's not these FIs who are at every point. You see such a huge difference in the momentum. I'll give you an example. The same foreign brokerages in the last quarter last year for China, because the lockdowns were getting removed, they said China is going to boom. Then around April, from 5%, 5.5% came down to 4.3%. And now again this week, it's come back to 5% and a good year next year with no change. You have $60 trillion sitting, 60 trillion yuan sitting on Chinese developer loans, which for 3 years we have been trying to get get some solution to it. 20 trillion yuan is sitting in Chinese mortgages. 90 million houses are staying unoccupied in China. Look at that inventory. That is equal to about 9-10 years of inventory. You can't even count the unfinished houses. You add all that up, there's such a big giant of a problem sitting there. $54 trillion is the valuation of the Chinese real estate market on which you have lent money into that. 54 trillion, it's bigger than the US stock market. You will not have a meltdown because it's largely government-owned companies or fronts for the communists who are all these companies. They will step in, but it will be messy like what happened in Japan. That shoe has to drop. I don't know when it will drop, in what way it will drop, but the bond market tells you today the Country Garden 2025 bond, you know what is it at? 2.5 cents to the dollar. all the Chinese developer bonds are running at 10 cents to the dollar.
Right.
So the bond market is telling you that there's going to be huge haircuts into this 60 trillion yuan loans. When it happens, we don't know. Can you accurately predict it? Definitely not. What is the best way? SIP, regular bonds, and staying invested.
All right, of course, caution is the word as global environment turns more and more volatile. Gentlemen, I would like to get closing comments from you. Aishwarya, coming to you, as we enter the festive season, of course, we've seen FMCG stocks not do all that well, given the fact that we've seen uneven monsoon, we've seen patchy recovery. I mean, there are signs of recovery, but it's been fairly patchy when it comes to rural demand. But do you think the festive season can revive the spirits when it comes to the FMCG stocks?
So if you look at the, obviously the rural growth has been under pressure. The monsoon, as you have said, has been very erratic. But if you look at the update that we have got so far from, FMCG companies, especially like Marico and all, things are not looking that great, and either they are like pretty subdued. So it's kind of like a moderate growth. And for me, it's more or less like, a no great show by FMCG companies. What I'm really excited about for the festive season is the discretionary angle. Businesses which have a discretionary exposure are something which should do really well in this coming festive season. So that is the area where investors should focus upon, rather than try to see more of exposure in the staples and all. If you look at the urban side, the income growth rate and all of that are pretty solid from that perspective. And whether even this World Cup, which is around the corner, will add more fuel to the discretionary pie of those businesses. So we are really excited about the discretionary angle more than staples there.
Right, closing comments from you also, Mr. Bagga. As we enter into the earnings season, of course, IT is expected to remain under pressure, and banks, I think the best of margin growth may be behind us for a bit. But which sector do you think will take leadership in the coming quarters, in the rest of the quarters of this current fiscal?
We have a poor global macro, and we have a national election looming in India. Normally going into it, the markets tend to be strong and then they sell off. This time we are seeing weakness in the markets because of FII selling. Are those conditions going to change? Does not look like that. If you are making 5% in a US money market fund, and if you can take some more credit risk, which most of these institutional players can do that, and you can borrow in Japanese yen, do a carry trade, people have made 40% returns. Easiest trade this whole year was borrow in Chinese yuan, which was a depreciating currency at very low rates, and put in the Latin American good countries. People have made 40% kind of returns. So that money which was searching emerging markets, given a strong dollar, given bond yields are telling you something is going to go wrong, that money is not willing to come into equities. And we are backfilling it with the domestics. That's good. That is helping our markets to hold on, but it's not going to run away. So you can take a 3-month, 6-month break. You'll probably find 20,000 levels on Nifty in a very good scenario, or you could go down to maybe 18,000. I don't see the chance of a very strong fall even on a global meltdown, because our macro is good and our flows are good. So they will always come in. There is enough money sitting on the sidelines looking for entry points at a lower level. So I'm not scaring anybody, but this is, a question is like you go to a doctor and instead of telling your own symptoms, you say, what is the medicine that's, doing the rounds, which is the latest? Oh, it's the anti-obesity drug. Oh, I am just, very thin, but give me the anti-obesity drug because that's the medicine which is the flavor of the month. We have to go back to looking at our own goals, our own aspirations, what will keep us sleeping peacefully or not allow us to sleep peacefully. Based on that, invest. And the India macro is good. India earnings will be good. Sectors, I think the amount of money going into infrastructure Anybody related to that will do well. The defense story, the railway story is very good. Again, valuations have run up. So probably you will get some correction and lower entry points to get in. What is not looking good, IT, any exporter, we'll have to see how the retail season goes in the US and Europe. For the textile guys, gems jewelry, looking at 20% kind of cuts in export. So the merchandise goods export part, probably near the bottom, but the damage is done because, the Christmas orders have already been placed. You will not get fresh orders now for diamond jewelry. So we know what is happening there from, the street. So those kind of sectors we have to avoid. The domestics are good. Will there be a cyclical uptick? Probably 2025. 2024 will be more of a consolidation move. So we have to save value for 2024 is what I'll say. Lot of complexity for the retail investor. So again, I say focus back, think of the doctor, tell your symptoms, which are your financial goals, and then try and address those symptoms by a financial plan. That's all. It's very simple. Diversify, quality, and stay invested.
Right. Right. So clearly policy and not the flavor for the markets event, because we're seeing pretty much a Nifty and Sensex pretty much flat there. Nifty holding on to that 90,600 levels or so, even the Sensex there. But market's not reacting, and that was looking at other triggers is like what Mr. Bagga was pointing out, that now policy is no longer that game changer. We're not going to see any much jumps there. Mr. Bagga, do you want to come in?
No, the point is when the foreigners are selling at every rise, how do you fight? And that's what's showing up, because there were shorts. Yesterday, there was a very big build-up in positions in Bank Nifty. I was watching it. I couldn't say, I said, is it some interested buying? What are people doing? And then we saw today a rise. And now there is it has all been given up. So very simply, if you watch this behavior, just watch these patterns. I am not an algo whiz kid. I don't know programming. I'm an old timer who looks at patterns like this and tries to figure out things. All I'll say is when the foreigners are going to keep selling, and that will change when they get lesser money in their domestic markets or the carry trade doesn't work. Very good trade right now, borrow in yen and put it in US money markets. That's happening. And or you put it in US credit funds, you'll make 8-9%. You add on leverage, you're talking dollar returns of 18-20%. Who will come to your markets in that kind of a scenario? Long-term guys, sovereigns, all those will keep investing. But the volatile money is going into the credit market. That market gets stopped out. You will not get a sustainable run in the markets. That's the very simple top-down global macro perspective.
Right, I think we've also come off the day's high. As Mr. Bagga was mentioning, there is a sudden fall in the Nifty Bank. In fact, it has come down to its day's low as we speak, and the Nifty also has cooled off from the day's high of 19,650 or thereabouts. But with that, I think we've come to the end of this special coverage. I would like to thank our guests, Mr. Bagga and Aishwarya, for joining in this afternoon. Look forward to having a detailed conversation with you guys on the markets and as and when the earnings trickle in. Well, with that, Stacey, we are done with this coverage of the RBI monetary policy. Of course, we will be watching out for the governor's press conference at 12 p.m. where we could see some announcements or some fine print of, the kind of measures, liquidity measure that the governor has announced. Stay tuned for that, and of course, come back and join us for midday market mood check as well post that. But for now, it's a goodbye from me and Stacey. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates.